Hello and welcome to this Practice Excellence webcast from the Accounting Web Studios in Bristol. I'm Tom Herbert, editor of the site. Thank you very much for tuning in, and thank you also to Free Agent for supporting this session and making it happen. So with everything that's been going on around Brexit, making tax digital, the general macro environment, it's very easy for small business owners and their advisors to perhaps miss rule changes or rules in general that can have a huge impact on their business. But fortunately, help is at hand, and I'm joined today in this session to cover the biggest tax issues facing small businesses by two titans of tax. Far side here is Emily Coltman, who is Chief Accountant over at Free Agent. Welcome, Emily.
Thank you, Tom.
And our very own Rebecca Cave, Consulting Tax Editor for Accounting Web and Director of Tax Writer.
Thank you, Tom.
So, a bit of housekeeping before we begin. All these sessions will be available on demand, so they'll be sent to you. You'll be able to watch them as and when at your leisure. So please don't worry if you're having any technical issues viewing the content. If you have any questions about technical issues, please email info@practice-excellence.co.uk. Moving on to questions, if you want to ask any questions in the session, there is a chat window to the side of this video. If you're watching it in full screen, you'll need to minimise that. We'll answer as many questions as we can, but we've only got an hour, so if we miss any, then we'll follow it up as part of a post-event article on Accounting Web. You'll also be sent a session summary email a couple of days after this with key takeaways from today, and you'll also get the slides. So please don't worry about that. Quick blast through the agenda. So Emily will be taking us through IR35 in the public sector. Then Rebecca will be tackling a pretty big beast, a hardy perennial, I think we described it as, the director's loans. Just before we came on air, I checked the Accounting Web forums, and two of the top 5 questions were on director's loans, so a big one. And then Emily will be taking us home with working from home, as it were. And as I say, we'll try and get to questions as and when they arise, but if there's time at the end, then we will answer some more of your questions. Just in terms of the chat window, as you can see, the video will be playing on the left-hand side, and on the right-hand side is the chat window where you'll hopefully be able to ask questions. So, IR35, 2 letters, 2 numbers, very small, but obviously big problems for accountants.
Oh yes, absolutely,
Emily,
Tom.
Where are we now?
Where are we now? Well, that's a very, very interesting question. So obviously at the 6th of April 2017, as all accountants know, there was this big change. For our clients who are operating within the public sector, who are working for public sector bodies, there was a big step change that it's now no longer the client's responsibility, our client's responsibility, but their engagers to determine whether or not the client is within IR35. And if they are, to pay them net of tax and employees' national insurance. Now, I understand, I've heard on the grapevine that some engagers are actually also deducting employers' national insurance, which obviously isn't good practice, so far as I'm aware. So if one of our clients is within IR35, then how should they represent that as a contractor in their accounts? Well, they put the invoice that they give to their engager in as income, and they have to charge VAT on that invoice, and that I think raises an anomaly, which I'm going to address in a couple of minutes. Because they raise the invoice with VAT, charge VAT to the engager and pay it to the revenue as normal. Tax and national insurance deducted will then show as a cost in the contractor's accounts, and the net amount, the salary if you like, can be withdrawn free of any further income tax and national insurance because that's already been suffered before the contractor received the income. So in other words, the corporation tax effect of earning that money is nothing, because although the invoice shows as income, the tax and national insurance and the net amount withdrawn show as costs in the accounts, so the corporation tax effect is nil. I am assuming, by the way, here that our client is operating through a limited company. The net amount theoretically could also be taken by the contractor as a dividend and then not shown on their tax return, but that I think throws up another anomaly. So let me address both of those anomalies just now. So one of them is that from a VAT point of view, This is a VAT invoice that is being created by our client and issued to their engager. VAT, vatable income. But it's being taxed as if it were wages, and wages are outside the scope of VAT. So what actually is that income? Is it taxable? Is it wages? It seems to be both at the minute.
Well, I don't think it is wages. It's only taxed as if it was wages.
Taxed as if it was wages, yes,
so
exactly.
From a VAT point of view, and you have to remember that the taxes act in silos, don't they? They don't relate across to each other.
That's true.
If you're looking at it from a VAT point of view, it's assuming that the personal service company is VAT registered and so has validly arranged a VAT invoice, it's inside the scope of VAT. Now, I agree with you that wages are outside the scope, but from a VAT point of view, it's not wages.
But I think you raise a very interesting point there, Rebecca, about the taxes are in silos, that VAT operates differently from income tax or corporation tax. For example, the income tax definition of a trade is different from the VAT definition of a business, isn't it?
Yes.
As an accountant, try explaining that to a client.
Well, indeed.
Yes. So there you've got this income that has been subject to VAT and taxed as wages, and if a client turns around and says, well, hang on a minute, I don't pay VAT on my wages when I work for my employer, why then have I got to pay VAT on this that's effectively being taxed as wages? Try explaining that as an accountant. The other anomaly I can see is that the net amount that the individual withdraws from their company could also be taken as a dividend rather than as wages. But wouldn't that be a disadvantage? Because in the limited companies accounts, the dividend of course goes out after corporation tax has been paid. So you're actually going to get almost a gain in the company's accounts on which they're paying corporation tax. Gain is perhaps the wrong word. You're going to get extra profit that you're going to be paying corporation tax on. So why would any contractor take that as a dividend? I can't see why they would, quite honestly.
Yes, indeed. And of course, taking a wage out of the personal service company is probably important for the individual's national insurance record.
Absolutely, yes, important for their national insurance record, although they will have already suffered national insurance on it when it came out of, when it came to them from their engager, wouldn't they? So they would have suffered national insurance, but that is also interesting as to how that income qualifies for state pension and other tax benefits. I don't believe that's yet been examined, has it?
I don't think it's been bottomed out, no.
No, it hasn't, no. So has it yet been bottomed out is another very interesting point, because I think it's too early in the IR35 in the public sector process for there to have been any cases settled by the courts. There are, I believe, cases that are going through the courts at the moment, aren't there, Rebecca?
Yes,
we were talking about that this morning.
Yes, there is a case that's going through the courts at the moment concerning actors and presenters at the BBC, which of course is a public sector body under these rules.
Yes, indeed.
So that case does relate to historical situations where the people were taxed or fall under IR35 before IR35 was converted with these special rules for the public sector.
Yes.
But those people, if the case goes against the individuals and they're found to be falling within IR35, they will definitely be within IR35 for the public sector on those contracts.
Yes, interesting. So that would be a legal case on whether somebody is or isn't within IR35 in the public sector.
Yes.
Yes, so that would be the first case of its kind as far as we know. There have been public bodies who've applied a blanket approach to any contractors working with them, who've said that if you are a contractor working with us, we are automatically going to put you within IR35. The NHS, I believe, was stopped from doing that. Public bodies aren't supposed to do that. They are supposed to take a case-by-case approach, but I understand that if a public body deems one of our clients to be within IR35, there's no right of appeal for the client. It just literally is what it is. And anecdotal evidence suggests that some local authorities are taking a blanket approach as well. Mark Morton did raise the question that if our client has gone through the HMRC tool and has proof that, well, proof if you like from the tool that they are not within IR35, that they can show that to their engager and say, look, I'm not within IR35, stop taxing me like that. But it's another moot point.
There have been big problems with the tool that people have been reporting about.
That's true, Tom. Yes, that's true. There have been cases where people have felt that it's given the wrong result. HMRC have said they'll be bound by it if the information that's input is accurate. But haven't there been cases where somebody who an accountant would believe to be within IR35, the tool shows they're not?
Yeah,
am I right? There?
That was certainly what was reported by, I think, Contractor Calculator.
It was,
I think we reported on it a couple of weeks ago.
Yes.
So, yeah.
Well, while we're on the subject of Contractor Calculator, I thought it was interesting to look at what the contracting industry is actually saying. So Contractor Calculator did do a survey that said 79% of public sector IT projects had been delayed for lack of contractors. The revenue said that wasn't true, but what Contractor Calculator found was that contractors were moving away from public sector to private sector because they didn't want to be within IR35, understandably. And there is a contractor called Mike Gibson who's actually led a successful crowdfunding round to fund a barrister to investigate whether IR35 itself is illegal, is legally allowed, we might say, and also whether the changes to the public sector rules are legally allowed. What Gibson argues is that IR35 prevents an individual from carrying out his or her duties as a company director because it's deeming them to be taxed as an employee. But of course, as we were saying about the VAT and the wages, Rebecca, taxed as doesn't necessarily mean is. Employment law is a completely separate thing from tax law. And that was one thing that the Taylor Review picked up on, was that tax law and employment law often are not do not give the same result. That you've got somebody who's taxed as an employee but does not get the benefits of an employee. And Gibson again says that that is fundamentally unfair. That if you've got somebody who's taxed as an employee, then they ought to get at least some of the rights of an employee. And that, I think, was what the high-profile cases of Uber and Deliveroo and others like that recently were about, wasn't it? That you've got these anomalies that are rising. Somebody is taxed in one way, but is actually not given the full rights in that situation.
I must say, I don't think Mike Gibson has a lot of hope of winning that argument, because fairness doesn't really come into tax.
No.
it's what the law says.
Yes,
and
exactly.
if the law says it operates like this, it does, whether it seems to be equitable for the individual or not. So
that's an interesting point.
I'm not hopeful of him winning, I'm afraid.
No. So you think that the people who've put the crowdfunding forward are unfortunately whistling in the wind?
Yes.
Yes. Yeah, I hate to say it, but I think you're right. I have a horrible feeling that certainly IR35 itself has just been around for too long, because it was 2000 it was introduced, wasn't it?
Yes, and there has been challenges as well. There's been challenges all the way up to the Supreme Court, which failed.
Exactly, yes. So why should this one succeed where others haven't? Unless it's a specific challenge to the rules within the public sector, why should this one succeed where others haven't? And that, of course, raises the $65 million question. Is this actually going to spill over into the private sector? This is something that I think has been debated on Accounting Web time and again, hasn't it, Tom? It's another hardy perennial. It keeps cropping up. Are these changes going to come into the private sector? There are accountants who are saying, well, why would the government have changed it in the public sector if not for almost a test run, that they're then going to roll it out across the whole of?
I think this is a misunderstanding, actually, of why it's gone to the public sector. I think the government's thinking of pushing it into the public sector was to prevent public sector bodies from using contractors. They wanted everybody to go onto the payroll of these various public sector bodies, but of course didn't provide the central government funding to allow people to come onto the payroll of, say, the hospital trusts or the BBC, Ministry of Defence, whatever it is.
Or indeed themselves.
Or indeed themselves, and local and national government. I think it would be a very brave Chancellor to push this out to the private sector, particularly at this time when they're trying to do everything else, including Brexit. Certainly HMRC's hands are full at the moment of MTD, for which they haven't got enough contractors to write the code. But that's another matter. It
is, exactly. and you've said exactly what I was going to say, Rebecca, that I think HMRC do have their hands too full with the whole Brexit and MTD side to be thinking about rolling out IR35 in the private sector, rather, unless the Chancellor simply says the rules that apply to the public sector now also apply to the private sector, end of story.
It's not going to happen.
No. Well, I very much hope you're right, Rebecca. I very much hope you're right.
That would be quite something, wouldn't it?
It would be quite something, Tom. Yes, indeed.
Indeed. Yeah, speaking of quite something, we'll move on now to Rebecca's Director's Loans presentation. So Rebecca, obviously, as I mentioned before, this is a hardy perennial on Accounting Web.
Indeed. I mean, directors' loans are always a problem. Directors, shareholders in their companies draw money out of the company, and it's really important for accountants to help the directors and their clients by having a strong accounting system which allows those directors to clearly record what they're taking out of their company, when it is taken out, and what is the categorisation of those funds.
Absolutely.
I'm sure your software does this.
It does, but like all software, of course, it's dependent upon the correct data being entered, because FreeAgent is a piece of software. It's not a human with a brain, so all it can tell is this amount of money was taken out of the company's account. It's up to the individual driving it to say that was a director's loan, that was a dividend, that was a repayment of expenses.
Exactly.
Yeah.
It's very important to get this right.
And at the time, I think,
and
as
at
well,
the time,
Rebecca, I think that changes to the rules in the last few years make it even more important to do that on a timely basis.
Absolutely. Because the accountant, if it's not done on a timely basis and there is a muddle to sort out, it's the accountant that needs to sort it out at the end of the year. And this has to be done to make sure there's an accurate picture in the company accounts and in the corporation tax return and on what's called the P11D, which is the annual return of the employee's expenses and benefits. So those three documents are actually crucial to get right.
Absolutely.
So people are quite aware that if a director has money out of his company and it's not a dividend, it's not a salary, it's a loan, there is a benefit in kind to be calculated on that loan if he's not paying any interest on it. Where the company is also a close company, and most small companies will be close companies because they're under control of just the directors or 5 or fewer people who may be the directors. There's also a corporation tax charge that's got to be considered when you've got a director's loan coming from the company to the director. But I'll come on to that charge in a minute. I'm just going to talk now a bit about the benefit in kind situation. Actually, under the Companies Act, directors are not really supposed to take money out of their company more than £10,000 a year. There is a clause in the Companies Act, section 197 and 207. If the amount is more than £10,000 a year, the company members, i.e. the shareholders, should give permission for that amount to be taken. This is widely ignored.
Especially, I would imagine, when the shareholders and the directors are the same individual, because then you've got the situation where, for example, if it were my company, I would be saying, I, Emily Coltman, give you, Emily Coltman, permission to take the money out.
Yes, quite. But in some situations where you have a family company where you've got people who are not actually working in the company,
exactly,
you know, other members of the family, if the director is going to take a huge amount out of the company as a loan, you know, maybe £100,000 or something, really all the members of the company should agree to that. And you could have rogue, well, not rogue, but disgruntled, say, shareholders who are not directly involved in the company, then challenging that transaction. So it could happen. It's something to be aware of. The other thing that accountants and directors may overlook, that if a loan is going to a director from a third party, not directly from his company perhaps, so to a director or employee from a third party, that loan may fall under the disguised remuneration rules, and in which case the entire amount is taxed as salary.
Not the amount above £10,000?
No, the entire amount.
Goodness.
Yes. So the benefit in kind charge, this happens if the total amount of loans to the person, the individual, is more than £10,000 at any time in the tax year. We've got to look at whether there is a benefit in kind to be reported on the P11D. You do this by working out how much interest the director should have paid on that loan, but hasn't. And you take the official interest rate, which is currently only 2.5%. It went down to 2.5% on the 6th of April this year. So you calculate 2.5% on the loan. You can do this on a daily basis or you can do it on an average basis. It doesn't really matter, but sometimes you will get a different amount which might be more beneficial. And then you see whether the director has actually paid any interest on the loan to the company. It has actually to be paid. And the difference is the benefit in kind, and this amount is reported on the P11D. The individual will pay tax at their highest marginal rate on that, and the company pays Class 1 national insurance at 13.8% on that amount. Now, loans may be payrolled, which means the amount, the benefit is treated as through the payroll each time the payroll is run. This doesn't happen quite so much, but a lot more companies are payrolling benefits now.
Yes, they are.
It's a topic that we've covered on Accounting Web. I know Kate Upcraft has covered quite a lot on payrolling benefits, hasn't she? There's also something else that could happen to the benefit. It could be treated as a salary sacrifice. Some people do get loans out of their companies, well, slightly bigger companies as employees, and it's treated as a salary sacrifice. So you have less salary and you have some as a loan. The salary sacrifice rules changed in April of this year, so that if you are actually giving up some salary in return for taking a loan or return for taking any other benefit almost, the amount that you're given up is what you're taxed on, not the special rules for the benefit. So in this situation, if an individual, an employee or director is giving up some of their salary to take a loan, it could be very dangerous because you are be taxed on the loan as if it's salary.
The full amount of the loan.
The full amount of the loan.
So
that's
in
right.
your earlier example, if you've got somebody who borrows £100,000 from the company, they would be taxed on £100,000 at one go.
If they had given up £100,000 to
Worth
take
of
that,
salary in order to take it.
you have to have the giving up bit as well in that transaction. But I've put a link in the slides to Kate Upcraft's article, very detailed article on salary sacrifice if you want to know how these new rules work.
The OPAs or operas, there seems to be some debate about what they're actually called, but
So what accountants can do really for their clients is to help them, as we were saying at the beginning, record exactly how much was taken out of the company. Is it categorised as a salary? Is it categorised as a dividend? Is it rent? That's possible, that the individual may have a property that the company is using, so it gets rent. Or it could be rent of another thing, such as an intellectual asset.
Yes, that's very true.
If the individual has created some intellectual property as their own and the company is using it, that's a sort of form of rent.
I suppose it is, yes. I've not thought of it like that, but yes, I suppose it is.
Or is it a loan? You need to be, you need to help, accountants need to help their clients work out what they're taking, what it is, when are they taking, but also when the loan is repaid.
Yes.
Because this is very important for the corporation tax charge. Because when we've got a closed company and there's a loan outstanding to a director or participator in the company, a shareholder, so it could be an associate of the director, their spouse perhaps, there will be a corporation tax charge if that loan is still outstanding 9 months after the end of the year, end of the accounting period. The corporation tax charge is 32.5% of the value of the loan. I know it's gone up. It used to be 25%.
Yes.
It is forever. It was 25%.
Yes.
But for loans advanced on or after the 6th of April 2016, it's now 32.5%. That can be reclaimed by the company when the loan is repaid to the company.
But only when the loan is repaid.
But only when the loan is repaid from the company, and only when the corporation tax return for the period in which the loan was repaid is done.
Yes.
So, you almost need to time this quite carefully.
Because that could be a long time lag.
Yes.
And aren't there now rules around when a loan is repaid and then almost immediately withdrawn again?
Well, yes, I'll come on to that. And there's always anti-avoidance rules.
Well,
always,
yes, exactly.
and there certainly is. But just to clarify on that reclaim, you mustn't forget it, because if you forget to do that reclaim of the, it's called the Section 455 tax, you need to do it within 4 years.
Yes.
Because otherwise you can't put that claim in. So don't overlook that where loans have been repaid back to the company.
Yeah.
But yes, the anti-avoidance, this is so
Yes.
interesting, isn't it?
Because there always is anti-avoidance, as you quite rightly said, Rebecca, because of course the minute a rule is changed, people start looking for a way to avoid the change, and therefore you need anti-avoidance rules.
And these anti-avoidance rules came in, it was one of those things that came in from budget day on the 20th of March 2013. Chancellor stood up, announced it, and it was effective from that point. So there are 3 ways the anti-avoidance can bite. First, where the loan is over £5,000, so you repay the loan of £5,000 or more to the company and then take it out again of £5,000 or more within 30 days. In that situation, the repayment and the taking out again are ignored. It's just treated as the loan continued onwards. And that obviously has implications for whether the tax is due or not, the corporation tax. In another situation, if the loan is bigger, if it's £15,000 or more that you repay to the company, and at that time there are arrangements in place for the loan to be advanced again to the individual, to one of his associates, that is also treated as a continuing arrangement.
Yeah.
So it's not that the loan is actually re-advanced to the individual, there are arrangements for that to happen. So that can catch a lot of things. You have to be very, very careful that there is nothing written, there is nothing agreed, that the loan will be repaid. Now, if the repayment of either of these sizes of loan is done out of taxed income from the company, so it's a taxed dividend, it's a taxed salary, these anti-avoidance rules don't apply.
Yeah.
One other area where the anti-avoidance rules, this is slightly more complicated, but this is where there's sort of a reciprocal arrangement, and I've done a little example on the slides which you can download later. Say we've got company C lends some money on an uncommercial basis to an unconnected person A. So A doesn't work for the company, A is not a director of the company, A is not even related to a director of the company. But A has a relationship with B, B owes money to A, so A forgives the debt that B owes to A, but B is a director of the company C who made the loan. So we've got a circle here. C lends money to A forgives the debt that B already owns to A, B is the director of C. The circle is complete. In that situation, the loan from C to A, remember A was an unconnected person, is treated as if C had lent to B, the director of C.
Interesting.
Yeah, and just to take a pause before you carry on, Rebecca, we've had a couple of questions in on the chat window. This £10,000 seems to be causing a bit of interest. So Katie asks, does the £10,000 mean the amount outstanding at the year end or at any point during the year? At
any point during the year.
Okay, nice and simple.
Yes, for the benefit in kind. Yes.
Good stuff.
Anything else?
And Rangeeth asks, we are keen to know whether the £10,000 limit is subjected to 32.5% ACT.
ACT?
I think he means corporation tax.
Yes.
Yeah.
It's not advanced corporation tax, it's just corporation tax.
But yes.
Yes. Yeah, there's no minimum. Yes, for the close company section 455 corporation tax, there's no minimum limit.
No.
So even if the amount lent out to the director was only £2,000 and £2,000 was still outstanding 9 months after the year end, there would be a section 455 charge on that.
Yes.
Okay. Fantastic. Thank you, Katie and Rangeeth, for your question. Simon has also asked, is it possible to download, print off the slides? Absolutely. They'll be made available. I think everyone who's registered for the session will get an email with a copy of the slides and a PDF document a couple of days after this session. So worry not. Back to you, Rebecca, and director's loans.
Yes, well, we're now going to look at where a director may lend money to his or her company. So the money is going from the director to the company.
That sounds quite unusual to me. Do directors often do that? Then I suppose if the company is in its startup stages, then the director might well lend money to the company to get it going. But sort of further down the line, how common is it?
Well, indeed. I mean, directors do put money into their company as loan, as you say, on the startup, or as the company is even maturing, when it's going into different markets or expanding. You know, the director may have money from other sources, an inheritance, or maybe previous wealth that he's built up while working in some other field, perhaps as an expert, and then decides to open his company. So there are occasions where directors might put considerable amounts into their own companies, and until recently it wasn't really worth the company to pay interest on that. Well, it might just have been overlooked that the company could pay interest on this amount to the director. But nowadays individuals have the personal savings allowance.
Yes,
an individual who is on the basic rate will have a personal savings allowance of £1,000.
Of course.
Those on the higher rate will have personal savings allowance of £500. If you're on the additional rate, i.e. 45% tax, you don't get any personal savings allowance at all. But if you have hardly any salary and it's only just being covered by your personal allowance, which is 11,500 at the moment, maybe you have a salary of only say 8,000 or something. You also have the savings rate band of £5,000. So anything that falls within £5,000 savings rate band, your £1,000 personal allowance, or maybe it's £500, that is taxed at zero.
Of course. Interest
is taxed at zero. So if you're getting interest out of your company, that's going to be taxed at zero in your hands. But because you are connected with your company, it should be paid at a commercial rate.
Yes. So in other words, the company should charge interest to the director at a commercial rate.
I mean, reaching that commercial rate can be quite difficult.
I beg your pardon, the other way around. The director should charge interest to the company at a commercial rate.
Yes. That's right.
Yes, it's confusing.
Now, if the company is not a bank, banks can pay interest without deducting tax.
Yes.
Now, and they all do, banks and building societies, and also things like national savings. Most personal companies are not banks. They must deduct tax at 20% from interest paid to individuals and report that interest on the quarterly CT61. Now, when the individual receives the interest, they can reclaim that 20% tax if the interest is falling within their personal allowance or personal savings allowance.
Interesting.
So it is beneficial
yes.
to have interest out of your company on a loan.
So in that situation, not only do they not pay any tax, but they also get to reclaim the tax that the company's paid.
That's right.
Is there any requirement then to repay that reclaim to the company?
No.
No. So it becomes in effect extra interest for the individual, or extra income for the individual.
Yes, that's right. Yes. Yes. Now it's all advisable to have a contract setting out the terms of the loan if you're going to do that. If you're going to start paying interest from the company to the individual, you need to set out the terms, when the loan is going to be repayable. Is it repayable on demand?
Yes.
How the interest rate was fixed, when the interest is actually going to be paid. Is it annually? Is it monthly? Is it quarterly? All these things really ought to be set out and clearly documented.
What can happen if they're not?
If they're not, if the interest is sort of rolled up and it's a bit vague, HMRC may come along and say, that's not really interest, that's remuneration.
Yes.
That's a salary, and we'll have PAYE and national insurance on that, thank you very much.
Exactly.
And there was a recent case on this, actually. Julie Cameron wrote an article for Accounting Web. The case was Ventura, and this was where the company really didn't make clear when the loan should be repaid and when the interest should be paid. And the interest in this case wasn't paid, it was rolled up.
No.
And HMRC successfully challenged it and said that rolled up interest is remuneration. So I don't know whether that case is going to be appealed. It's quite a recent case, but that's the attitude that HMRC will take if the interest isn't clear and it isn't actually paid. So the accounting treatment of a loan from the director to the company is determined by FRS 102, which is the subject of a lot of discussion on Accounting Web.
It certainly is, yeah.
Our friend Steve Collins is just excellent on this topic, isn't he? And he has actually written an article on the accounting effects of FRS 102. I've put the link on the side for directors' loans in particular. And this, I must stress, is loans going from the director to the company, not the other way around. But FRS 102 was actually altered this year. And the change was backdated the 1st of January 2016. Yes, a roll of eyes. But it was a good change because it means that loans in this particular circumstance where the company and the director are connected, it's a close company, it's a small company, you don't have to do this crazy net present value thing.
Well, that's something anyway.
That's a relief, isn't it? So you just value the loan as we always used to on historical cost, and it's all fine. We know what we're doing.
That is a relief, because certainly I've never done an NPV calculation since my exams, and I bet I'm not the only one.
Indeed. But Steve Collins goes into great detail in his article, which I've put a link to, onto what is affected and why it's happened.
Fantastic. Before we move on to Emily's section, we've got another question that's come in. Rangeeth's been back on. I hope I'm pronouncing that right. Apologies if not. Close companies may consider gifting shares to family members in order to utilise the £5,000 dividend benefit. Would it cause any problem with HMRC?
Yes and no. It depends. That's a very, very big question. But briefly, if you mean family members who are children, that would probably not be an effective transaction, because if the children are under 18, they would not have capacity to make the decision to receive the gift, or it would be the directors, the parents, making the decision as to whether the dividend was paid on the loan. For an adult child, it should work, but you've got to be very, very careful about this. You're going to fall into the settlements rules.
Yes, that's what I was
which
just going to ask.
is a really big topic. Gifts between husband and wife are normally okay if it is a full gift of shares that have full rights to capital and full voting rights. So the person who receives the shares is put in the same position as the person who originally had the shares. If you're trying to gift shares that have restricted rights, then you can fall into the settlements rules. And when I mean the settlements rules, it would pull back the income that was apparently gifted through gifting shares to the person who originally had it. So
it would be treated as the income of the donee, rather than of the donor. Is that right?
Yes, it's very tricky, and advice should really be taken if you're going to do this.
Absolutely.
Good stuff. One more director's loans one for you, Rebecca. Paul in Leeds asks if the interest on a director's loan is credited to the director's loan account annual, e.g. when accounts are prepared. Is that acceptable?
Well, that's what you were talking about with interest being rolled up, isn't it, Rebecca?
Yes, I mean, it should really be actually paid out of the company to the director. If it's properly documented, you are on slightly uncertain ground if it's not actually paid out of the company, but having a loan agreement clearly showing what the interest is and, you know, what rate it has been calculated as. Perhaps, I mean, a crucial thing I think I forgot to mention actually, that if the director is lending money into his company, that money needs to be used, you know, for the company's trade.
Exactly.
You can't just treat the company as a money box and put money in and get interest out. The company has got to be using the money for the purposes of its trade or business to make the interest a deductible expense for the company.
Otherwise it will be treated as not allowable in the corporation tax computation. Yes. So if, as you said, the director is treating the company effectively as a second bank account and just putting money into it, then the interest is not deductible for the company.
That's right.
That's right.
Fantastic. Thank you very much, Rebecca. Emily.
Thank you, Tom.
I'll leave the working from home piece to you.
Thank you very much. So, yes, I think that as accountants working for small businesses, we're going to have a lot of clients who work from home. It is a very common thing to do, particularly in the early stages of a business. But I'd like to look at some of the key tax issues for a business that's based at home. If the client's a sole trader, then obviously we've got the choice of, do we use the flat rate for gas and electricity only, which is determined by how much the client works at home. But that only applies to electricity and gas, so you need to think about other costs like rent, council tax, insurance, mortgage interest and what have you, and look to possibly include a percentage of those. One point where a lot of people, I think, don't necessarily know this is that you can't claim for water unless there's a separate water pipe, and that is just for business. So for example, if we've got a client who's running a dog grooming parlour from their home and they've got a separate pipe installed, they would be able to claim the cost of that water. But additional water for making tea and coffee and using the loo while you're working at home, that's not going to be allowed. One question that I do quite often get asked, and which I haven't yet found the answer to, is what happens if the bills for the household costs are not in the sole trader's name, or not only in the sole trader's name? Say they're in a partner's name or a housemate's name, or they're in shared names. I'm personally not aware of any guidance that says you can't in that situation claim part of the bill. So have you seen any, Rebecca?
I haven't seen any guidance on that. I think HMRC haven't really kept up with the modern situations.
Oh, absolutely not.
When people are sharing homes who are not necessarily in the same household.
Exactly, yes.
So no, I think the guidance is way behind the curve on this.
Yes, exactly. And that could also apply in a lot of other situations like free Wi-Fi in the coffee shop, but that's obviously not the subject of today's discussion. But yes, I think the guidance in a lot of areas could do with updating for modern living and working practices. Where I think the plot thickens a lot is where the client that we're looking at who works from home is not a sole trader but the director of his or her own limited company. I know that different accountants take a lot of different approaches to this. I've heard of accountants who say, well, I'll just put in £4 a week because the revenue have said they won't challenge that, end of story. I've known of accountants who've said, well, let's have the individual rent a room to the company then pays rental income to the director, and on the director's own tax return you get total rental income less total costs. Those two are one and the same, no extra income for the director to pay tax on. It is worth pointing out rent a room allowance doesn't apply if the room is used for an office or for business, so the director cannot use rent a room allowance. But when we look in a bit more detail at the rules, if you are an employee and you're working at home, strictly speaking, you should only be claiming extra costs that are incurred because you actually work at home. So that would be sort of extra electricity, extra gas. You can't claim a percentage of any costs that you would pay anyway, whether or not you were working at home. So that's your rent, your council tax, your mortgage interest, possibly your insurance, although you might possibly have to pay a bit more insurance to work at home. But they should only claim the extra costs, or else they'll get a taxable benefit charge. And also, and this is where I think it gets really sticky, an employee should only be claiming working from home costs if the work they do at home is substantive duties of the employment. In other words, work that actually earns money for the employer, not merely admin. Now, if you'll excuse me, I'm just going to read a bit out here, because this is something I've extracted from the HMRC internal guidance manuals. And we're looking at the case here of Miners versus Atkinson, which is a director working for his limited company of which he was the only employee, so it's your classic one-man band service company. Mr. Miners did some work on his papers in the evenings at the flat during the week. Most of his duties as director were carried out at his home address. Although Mr. Miners did some work at home, the work he did was not part of the substantive duties of his employment. In these cases, a distinction should be drawn between A, the duties required by the individual's office as a director and other minor clerical or administrative work, and the duties performed for the client that earn money for the service company. Only the second class of duties should be regarded as substantive duties. If the work carried out at home all falls into the first category, in other words, duties of the directorship, minor clerical or admin work, no deduction should be permitted for working at home. That's what the Revenue's internal guidance say. And it also says that for service companies, and again this is a direct quote, it will usually be possible to demonstrate that the work that the director or employee carries on at home is not the substantive duties of the employment.
We should remember, of course, when you're reading that out, that this is guidance from HMRC.
That's
it's
very
not
true.
the law.
That's very true.
HMRC seem to think their guidance is the law, but it's not the law.
That is very true. But I do also think that an accountant and their client would have a big battle on their hands trying to fight it if the Revenue's guidance to their employees says this, because the Revenue are going to be referring back to this and their employees will keep saying it.
If you wanted to take a case to the tribunal on this point, the tribunal would not look at this guidance, they would look at the law.
Very true, very true.
If, you know, if you have a very good argument to prove what is substantive duties, which is not in line with that guidance, you know, the tribunal may well come down on the side of the taxpayer.
Very true. Yes, that is very true. And one other point that I'd like to raise is you were talking about the importance of putting in place proper agreements, Rebecca, when we were looking at the whole aspect of interest paid. So assuming here, if the accountant were to work out the full amount that the individual could claim for use of home were that individual a sole trader, and then put that as a payment of rent by the company to the individual, do you think that the Revenue could challenge that and say, well, I don't believe that's rent, I think that's a payment for use of home, so I think that's a taxable benefit, I want some tax and national insurance?
I think it depends on whether there was a licence to occupy between the company and the individual.
Licence to occupy?
Yes, a licence to occupy rather than a lease.
Now that's interesting.
That's something that you would maybe have to get a lawyer to draw it up for you, but a lease generally gives you an exclusive right to an area. Whereas a licence to occupy gives you a right to occupy that area for, say, 8 hours a day or something. So you're not getting exclusive use. So a licence is usually better to use than a lease, but in either case, it's good to have it in writing.
Yes.
And if you do have the terms in writing on a lease or a licence to occupy, HMRC would find it difficult to challenge that.
Yes, well, thank you for that. And also the interesting point about where you mentioned the licence to occupy that lets you use it for part of the time. I think that's critical because, of course, if the individual owns their home and they use a room 100% for business 100% of the time, when they come to sell that home, then the room becomes a non-personal asset. Was that how you described it?
Non-residential.
Non-residential. So it does no longer qualify for PPR, no longer qualifies for private residence relief, no longer qualifies for principal private residence. It becomes a business asset on which capital gains tax is due. Of course, if the individual is renting their home, there's no such issue because there's no such asset. But the way round it, of course, is to use the room exclusively for business part of the time and exclusively for private use the rest of the time. So you have a room that is office and music room or office and spare bedroom and is used separately at different times for the two. It's interesting, actually, the American approach is that in order to claim income tax relief if you're working at home, you have to use a room just for business and never anything else. So you can't have the case of the gentleman sitting in his living room doing work from home and claiming tax relief on it. He couldn't do that, not in America. Just an interesting side point.
I suspect the rules are different in different states of the America.
That was the national guidance, but yes, you're right. Of course, in America, you get the federal tax rules and the national tax rules. Although there is an argument that says we could be taking the very first tentative steps towards that here because we've got the whole Scottish and Welsh rates of tax.
Don't get me started on DT.
You're a big fan of that.
Okay, pretend I didn't say that, Rebecca. We'll talk instead about the garden shed. The garden shed, the garden office, because I think this is another perennial that crops up reasonably often in any answers, doesn't it, Tom?
Again, absolutely.
Yes, sort of what happens if you've got a client who works in a garden shed or garden office. Well,
like David Cameron.
Like David Cameron, does he?
Well, he famously bought himself a garden office, didn't he?
Was it David Cameron? I thought it was one of his team.
No,
I remember somebody did. I hadn't realised it was DC himself.
It's a very fancy garden shed as well.
Yeah. Why am I not surprised to hear that? So My understanding is if you're actually constructing a shed or garden office to work in, the shed itself, of course, wouldn't qualify for capital allowances because it's fixed. It's not a movable structure, unless you could move it. Of course,
as David Cameron's shed was.
Yep, and
it
of
was
course
movable.
You
apparently.
do get a shepherd.
I thought it was on wheels.
Yep, well, you do get shepherd's huts on wheels,
Yes.
because the shepherd used to follow the flock around and sleep in his shepherd's hut on wheels that he could push from place to
It
place.
never occurred to me before now that that is why he had a shed with wheels. But
Yeah,
there you go.
that's what they were. They were the traditional shepherd's hut. Yeah. Yeah, but so yes, if the shed is not movable plant, and I don't think most sheds are, if the shed is not movable plant, then obviously it doesn't qualify for capital allowances. The fixtures and fittings might well do. The electrical wiring could be classified as integral features, as could heating, and qualify. What happens then if the shed is sold, or if the whole property is sold, including the garden with the shed? There, I think, is where you start getting into the thorn bushes, because there you get the question of, does principal private residence relief actually still apply if you've got the big garden with the shed? Because we discussed a couple of weeks back, didn't we, the case of Mr. and Mrs. Ritchie in Northern Ireland, who he wasn't actually working in his shed, he was using it for a hobby. His hobby was ploughing, so he was keeping his ploughs in his shed. And there was the question of, does this big garden with this shed in it actually still qualify for PPR, because the garden was bigger than the half a hectare?
Yes, it was quite extensive. I think it was 0.7 of a hectare or something.
Exactly, yes, it was a big area. And that went to tribunal and it was allowed, wasn't it? I think that Mrs. Ritchie made the point that her husband's priorities were A, the shed, B, his wife, C, his children, in that order. And the tribunal accepted, therefore, that they needed the shed for enjoyment of the property.
Yes.
Yep.
It's ploughing an interesting furrow there in tax.
Ha, Tom.
I think in that case it was particular that the shed existed before the house did.
That's true, it did,
so he had
didn't
bought
it?
the shed and the land to use for his hobby before he even built the house on the land.
Exactly, yes. So for him it was absolutely vital to have this shed and this area of garden. Yes. But I think that in the ordinary way, a big garden with a shed that was sometimes used for storage of tools, I don't think that would qualify. I don't think that would wash.
No.
No. And also, where you've got the case of allocation of costs between the business and non-business use of a property, there was that case that you told me about, Rebecca, the Lilybank Farm case. Yes. So that was rollover relief, wasn't it?
Yes.
Yes. Where you had a business, they were packing model kits, was the business, and they used part of their big house and part of the outbuildings for storage and for packing and assembly and what have you. And when their original property was sold, they acquired a similar property. The directors occupied that as their home. They also used the outbuildings for the company's trade. The company claimed rollover relief for the gain made on the first. Yes, exactly. Yes. And the tribunal found that only the areas of the property that were actually occupied for the purposes of the trade would actually qualify for rollover relief, not the whole asset, not the whole house. So they cut back the amount that the directors had claimed. Yeah. So you do have to be a bit careful, would be what I would say, with sort of how you use different areas of the property, whether that is a shed, whether it's a room, whether it's another outbuilding that's not joined to the property. I think the whole thing is go through the figures very, very carefully and assess which bits are used for the purposes of the trade. But the Lilybank Farm case made a distinction between used and occupied, didn't it? For the purposes of the trade, yes.
And of course, always document it if you possibly can.
Yeah.
You know, why are you using this building? What's it using for? How many hours in the day? Is it a permanent use? Is it an exclusive use?
Exactly. Write it down, but also make sure that the facts fit what you've written down, because if you write down one thing and the revenue go and look and find evidence that it's actually something very different, they're not going to take notice of the written document, are they? They're going to disregard it, or as far as they can disregard it, because they'll look at what actually happens.
Yes, indeed.
Yes.
Wonderful. So a couple of minutes before we wrap up, but we've had another question in. If a limited company is run from home, would the director be able to charge the cost of electricity and council tax to his company, and would there be capital gain tax issues at time of sale of the property? Is it apportioned for the number of years in business in the case of any CGT?
Well, that's very interesting. There's, I think, 3 points to pick out there. Electricity, council tax and the sale. My understanding is that if the director were carrying out substantive duties at his home, in other words, he was carrying out work that actually earned the company money rather than just doing his admin at home, then my understanding is extra electricity, yes, he would be able to claim that. Council tax, no, because he's got to pay that whether or not he's working at home. If you're the director of a company, you only get to claim the extra, not costs that you would pay anyway. The company could, of course, pay that money to the director, but it would be a taxable benefit. Yeah, it would become a taxable benefit for private use of an asset. Would it be private use of an asset? Actually, probably not, because the asset doesn't belong to the company, it belongs to the director.
It will be remunerating the director for a personal expense.
Yes, but it would be a personal expense, not a business expense. Yeah. The council tax wouldn't count as a business
However,
expense.
you know, if the room is being used exclusively for business, theoretically should be paying business rates on it, not council tax.
That, I think, depends on actually what the director's doing at home.
Yes.
Yes. I think business rates depend on things like whether he's having clients come to visit him at home, because you do get a case of, for example, a doctor's surgery.
That's indeed, yes.
Yeah, where they've got a lot of people coming and going.
You can have doctor's surgeries, but also people setting up, you know, nail bars in their front rooms.
Yes, of course.
That sort of thing. You know, even sort of therapy rooms,
yes.
perhaps. You need to be very careful about whether it is still part of the home or whether it should be treated as a business premises for business rates.
Absolutely right. Yes, of course. And then that brings us on to the whole capital gains tax question, because if you've got part of a property that's used exclusively for business, then that becomes a non-residential asset, as we were saying earlier, and yes, there would be capital gains tax to pay. And that point about the computation, about whether it would be apportioned for the number of years that the individual has been in business, presumably the gain would accrue over the years of the business?
Yes, I mean, it depends when, how much of the property is used and when it was used exclusively.
Yes.
Well, it's down to the exclusively point. You know, if the business is, you know, creating software in the spare room, as you said, you know, and it's also used for family guests when they arrive, then that's not an exclusive use. If it is an exclusive use, yes, you have to work out when the property, that part of the property became an exclusive asset for the business.
And again, that would have to be carefully documented, wouldn't it?
Yes.
Because otherwise it would be very difficult to prove either way.
So you're doing an apportionment on both points, really. You're doing an apportionment of the exclusive use out of the total area of the property and the total value of the property, and then at time and apportionment that you may have used it only for part of the time that you owned the whole property. So two apportionments to be done in the capital gains calculation. But remember, the individual also has a capital gains exemption each year, which may well cover that amount. The capital gains exemption is quite large. It's what, 11,300 now?
Yes.
So if the gain, even if there is a gain, it may be covered by their individual capital gain exemption.
Yes, but you'd actually have to crunch the numbers to be sure of that, wouldn't you?
Yeah.
Yes.
Wonderful. Well, that about wraps things up for now. So thank you so much, Emily and
Pleasure,
Rebecca.
Thank you.
And thank you very much also to Free Agent for supporting this session. The slides and a downloadable PDF asset will be sent out in the next couple of days. Do look at accountingweb.co.uk for more details, and if you're watching this live, do join us this afternoon at 2 o'clock for the VAT live game show. That's about it for now. Thanks for tuning in. All the best.